Newfoundland. People with courage and foresight have come to mine this rich land for hundreds of years. Now, the next chapter in Newfoundland's mining history is being written. To learn more, find us online at newfoundgold.ca.
Welcome back to Palisade Radio. I'm your host, Tom Bodrovics. Joining me today is returning guest David Brady. He's a money manager and Sprott Money contributor. How are you today, David?
I'm great, Tom. Thanks for having me back on. I really enjoy our conversations.
As do I, David. The last time we spoke was at the beginning of July, and you highlighted the short-term risks to the downside for the metals and the miners. So why don't we start by kind of recapping where we are now, and we can go through some of the key points from the fundamentals, the technicals, sentiment, positioning, and we'll just kind of go from there.
Sure. So the call back on July 6th, if I can remember correctly, what I stated was that the risk of a pullback was imminent. And when I say imminent, I specifically stated that it would be over the next 2 to 3 months from that period. So August, September timeframe. And fortunately, that's what has ultimately transpired. The upside, I did say there was a potential that we'd break the record of 1923. We did exceed that. Now, I will admit I didn't expect it to go up above that as much as it did. It did reach 2089. I thought it might get to 2000, but it overshot to the upside. But as we have learned that since the Fed and Congress turned off both the monetary and fiscal stimulus, or at least dramatically reduced it, you've seen the pullback transpire right on schedule. So where are we at now? We're a little bit in no man's land with regard to the metals and miners, and I would say this with regard to all markets, because you've seen the dollar finally find a bounce. Stocks came off and are now rebounding. You get metals and miners have dropped to my target levels. As I tweeted earlier today, that actually silver, GDX, and SILJ have all hit my minimum targets on the downside. Gold has not. I'm still looking for 1800. So there is still a risk of further downside in the sense that, put it in Elliot Wave terms, we had our wave A down. This is the wave B dead cat bounce. And there's still a C to come on the downside. Or we're already in C. We've completed 3 waves of that. Now we're in the 4-wave bounce, and we've got a 5th wave down to complete all of C on the downside. And that is still a possibility. But all of this is related to stimulus. If you look back at March, we had the lows, and what did the Fed do in response? And the lows were coincided with the lockdowns, which in turn coincided with COVID-19. And then the Fed turned on the spigots, printing $3 trillion inside 3 months, $1 trillion a month of stimulus. And as I said at the time, in response to some economists who said, yes, they were correct in that the economy was melting down as a result of the lockdowns, but they also said that the crash in stocks would continue, and this was, the event that they were waiting for on the downside. I said in response, no, that liquidity is what drives markets, and the Fed is pumping it into the system. And that's exactly what they did. And markets would go up to new highs in stocks, and gold and silver would soar, and the dollar would suffer. Well, stocks went up to new highs, gold hit a new record high, silver took off and hit its highest levels since, 2013, I believe. And meanwhile, the dollar dumped 11%. Well, what happened in July and August then? In July, the FOMC, the Fed officially took its foot off the gas pedal. They cut their purchases of U.S. treasuries by 75% going forward. And the following month, you had Congress follow up on that by, as many people expected them to, extend the $600 a week that every American was getting. And as I said back on the July call, I think there's a risk that that does not happen, actually. And sure enough, it didn't. The Democrats and the Republicans are still deadlocked on this issue. So not only did you get a dramatic cut in monetary stimulus, the fiscal stimulus that was going out to newly unemployed Americans, that was terminated as well. And now they have to rely on their ordinary jobless claims benefits and unemployment insurance. So you've taken away a massive amount of monetary and fiscal stimulus, and what happened next? Well, the dollar found a bottom, started to head up. Gold and silver dropped from their peaks. Stocks as well dropped. And now we've gotten a bounce. And for me, that bounce is in stocks just a short squeeze, because the short levels in stocks based on the COT data were at levels the most short since 2008 and 2000. And we know what happened after that. Well, now we're getting a short squeeze. In gold and silver, we had reached oversold levels in both, and now we're getting a bounce. And in the dollar, you had overbought short term after its little bounce, and again a little correction of that, but that has further to go on the upside in my opinion. And the main reason I see for that is the commercial banks. If you look at the COT data for the dollar against multiple currencies, and by the way, Ole Hansen on Twitter has the best graph. It's in one picture of all the positions in the dollar relative to all other currencies. That it's the best data point out there with regard to the dollar and where it stands today and what the positioning is today and what that means for the dollar going forward. Well, the commercial banks have been in the past week or two at their highest long dollar position in many, many years. So the smart money is betting on a dollar rally. Now, we've had a little bounce in the dollar and they're starting to cut those longs. But that has a long way to go. So that means, for me, the dollar still has more upside. I'm on record for saying I don't think the dollar's rally ends until we see somewhere around the 97, 98 region in the Dixie. It could go even higher or it could fall short, but that's my target area for the peak in the dollar. And why does that matter? Because all markets right now are correlated. I wrote an article for Sprott Money 2 weeks ago where I said the markets are a coiled spring ready to explode. And what I meant by that is if you looked at the RSIs for stocks, precious metals, real rates, tips, and the dollar, if you looked at all of those markets, you would see that RSI was around 50. They were all neutral. And they had all been, their price action was compressed in all. And I said it was about to explode. And explode it did. Gold and silver dumped. The dollar shot higher. Stocks dumped. And bond yields have been inching up recently, but they're in a stranglehold right now. They're saying that the Fed's saying that they've turned off the idea of yield curve control for the time being. Well, as Craig Hemke accurately points out, they've been doing it since March. Just look at the graph of bond yields. They've just gone sideways. They're in a tight little range. But in essence, what I'm saying is that you've got the dollar bounce, you've got gold and silver come off, and stocks come off. But now you're getting a bounce back. I think this is all short-term in nature. And that until we get stimulus, new stimulus, which was the original reason for the drop on the one side, stocks and precious metals, and the rally in the dollar on the other side, until we get new stimulus in the form of a Treasury helicopter drop, U.S. Treasury that is, Congress, Republicans and Democrats agreeing on new checks in the mail to Americans, and the Fed paying for all this by buying all the resulting debt, until you see one or more of those forms of stimulus come about, fiscal and or monetary, the risk remains down, in my opinion. And on top of that, you've got the elections ahead. You've got escalating tensions with China. And going back to the elections, it's looking more and more likely that this is going to be the most highly contested election in history, maybe even surpassing the hanging Chads issue in 2000. So you could get legal battles going on and so forth, delaying the official results of who won the election. Do you think stocks are going to go up in that environment? I would be surprised. So we have two questions. Are we going to get another round of stimulus from one or more of the authorities I just mentioned? I think that the probability of more stimulus is extraordinarily high. And one of the main reasons I say that is, aside from the fact that the Fed has always rowed to the rescue, why would they change that now? Is because the alternative is systemic collapse of everything, ! So I would expect them to continue doing that. But more importantly, look at the US Treasury's cash balance. It's normally around 400 billion. You know, it can go down to even close to zero, and then it can go up north of 400 billion. But the average balance on the US Treasury cash account is around 400 billion. It's now close to 2 trillion. What is that war chest for? So they're going to spend it some way or another. And that, for me, is a great data point that just backs up everything else I'm seeing, in that the Fed has been saying, even Powell said it today, they're waiting on Congress to act. That, to me, is positive down the road, and the market might take it as positive short term, but that's extremely negative short term, because what in essence he said is that we're not going to do anything. We're sitting on our hands until Congress agrees on some new fiscal stimulus. And until that happens, we're not doing anything, which makes sense, because until we get the fiscal authorities spending more, whether it's the Treasury wants to drop $4 trillion in helicopter money, or Congress agrees with the White House to send out more checks in the mail to people, there's no more debt for them to buy. And that's how QE works. They need more debt to justify printing more to buy that debt. So, in my opinion, it's not a question of if we get stimulus, it's a question of when. And all they need is an excuse to do that. The excuse, I believe, will be, as always, a sharp drop in stocks. It has little or nothing to do with the economy. The economy is in meltdown right now, and it continues, in my opinion. But a sharp drop in stocks, in my opinion, as always, will be met by new stimulus. But when does that happen? Well, honestly, I don't know. But the answer I would give to that question is it either is going to occur before the elections, imminently, or after. Well, based on Powell's comment today, it's going to be after. Because unless the Democrats are willing to agree on something before the elections, which I seriously doubt now, then the agreement on new checks to Americans will be after the elections. And given that those elections could be highly contested, you're talking about potentially mid-December, could be January before we get new stimulus. What do you think happens to stocks and precious metals in that environment? No stimulus, high degree of uncertainty, escalating volatility, heightened degree of fear. I think they go south. Meanwhile, what happens to the dollar? It goes up. So although we've reached these levels in gold and silver that I anticipated back in July, I still think that there's a risk of further downside to come. Now, I could be wrong, but I still believe that, put simply, I don't think the dollar has peaked. Could gold and silver go up with the dollar? Yes, but the track record to this point is they're being inversely correlated. Could that change? Of course it could. But I believe that if the dollar continues up to 97, 98, gold could see lower lows yet. Silver too, the miners. Stocks could see lower lows yet. But let me make this emphatically clear, as I did way back in July. This is the last great buying opportunity. Well, maybe not the last, but it is a fantastic buying opportunity, a buy the dip opportunity, both in stocks and precious metals. I will say this as well. No matter how high stocks could go, and they could double over the next 2 to 3 years. Well, wait them after that is a whole other conversation. But over the next 2-3 years, they could double. Precious metals, and especially the miners, and let me take a step back here. Gold is going to outperform stocks, in my opinion. Silver is going to outperform gold. Miners are going to outperform silver. Junior miners are going to outperform senior miners. This is all my opinion. With all that in mind, my favorite vehicle for a trade over the next couple of years, not investment. Investment, you should be in physical metals, but for a trade and for the highest degree of upside, you got to be looking at Silj, the junior silver miners. That thing jumped 150% in 6 weeks post the March lows. 150% in 6 weeks. Can you imagine what it's going to do if this stimulus does transpire and you get the Fed not printing 3 trillion, 6 trillion, 10 trillion, who knows? You get Congress not sending out $600 a week to Americans, 1,000, 2,000. You get the US Treasury dropping money, not from helicopters, but bombers. Not 1 trillion, maybe 2 trillion, maybe 3 trillion, 4 trillion, who knows? In other words, making the rally since March to September, August, September, look like just a preview for the main event for what's next. And just imagine how high stocks could go, gold could go, silver could go, miners can go, but especially the junior miners. And my point is, and I'll end here by saying, I still think that there's a risk to the downside despite this bounce. I have already averaged in personally a small amount of my allocation for what I intend to buy on this dip. Like I'm at around 20% now in terms of what I've bought, primarily in the junior miner space. But I still think there's room for further downside. But regardless, the risk reward at these levels are hugely in favor of the upside. even if we do see further downside, which on balance I do expect, the risk reward here is massively to the upside, given what's potentially going to come down the road. But if we get even a further downside, which I think we will, so I'm waiting to add some more down there, given my expectations for the dollar going forward, and we get that stimulus to follow, this will have been the best buying opportunity you're going to get for at least the next 3 to 6 months, and perhaps ever. And I'll stop there and let you jump in here, Tom. I could go on all day.
Well, I know you can, David, and that's what makes our conversation so interesting, is that you hit all the cogent points and you just destroy my list of notes that I have for you. But one thing I would like to get your thoughts on is if you think that there's a difference between a Biden victory or a Trump victory in the markets and what that's going to mean for, let's say, the stimulus package going forward, or if it even matters.
Well, you hit it before I said it on the tail end. I really don't care. As you know, Tom, I'm more or less apolitical. I believe they're all the same. I've said that on Twitter. I mean, people can get bogged down in left-right views, socialist and right-wing and all this jazz. As far as financial markets concerned, I don't think it matters. It only matters to the extent of how much fiscal stimulus do you get. The Republicans may be a little more tighter with their wallet, but do you believe that they're not going to spend more if and when Trump gets reelected? Of course they are. I mean, Treasury, as I said, the U.S. Treasury, which is under a Republican administration right now, has built up a $2 trillion cash balance. They plan to do something with it. I believe that the Fed is the one you got to watch because they're just waiting for an excuse to print and they just need more debt to do it. And that debt will be forthcoming. And whether it's Biden in the White House or Trump in the White House, you're going to get that either way. Biden may spend more initially than Trump, but then again, he's going to probably hit corporations with more taxes than Trump would. I think that's an obvious statement. But at the end of the day, it's de minimis, the difference between the two. I think whoever's in the White House, it's going to be ultimately positive for markets. The reason why this matters, these elections, is people are wound up in, for all different various reasons, which I'm not going to get into, about which one should get elected. They've both got their vote ready. And there's two very polarized camps in that regard. But from a financial market perspective, whether or not we get stimulus, as I've said, given Treasury's cash balance and what the Fed has said to this point, I think it's a done deal. And regardless of who's in the White House, you're going to get additional fiscal spending. So at the end of the day, it means little who's there. What matters is the process to decide who ultimately wins out, because that could take a while. As I said earlier, this could be a whole lot worse than the hanging chads in 2000, which, that decision had to go to the Supreme Court to decide who was going to become the next president of the United States. You can see that, and then some, this time around easy, with the whole concept of mail-in ballots, etc. So the uncertainty around who's going to get the job, regardless of whether or not it has any impact one way or another to the markets, that alone could create more volatility in the market. Markets hate uncertainty, which pushes all of the risk on markets to the downside. Now, you will get some people in the precious metals community going, well, that should be good for gold and silver, safe havens that they are. Maybe they, as I said, they could rise with the dollar, but, I'm not going to pin my hopes on that. And that's why I'm already buying a little bit here. I could be wrong, and we have seen the lows. But I'm already long since 2015, so this is just the last allocation I'm making. So if I miss the boat on the downside, I don't really care, given the upside to come. So if we break 2089 and start hitting new highs, you can feel comfortable that it's going to go to 2300, maybe even 2500 thereafter before we get our next pullback. So just jump on the bandwagon at that stage. But to answer your question, I don't think it really matters who's in the White House, but the process to find out who it will be does. If it's quick and dirty and it's a slam dunk and either the Democrats sweep or the Republicans sweep, then, markets take off. Where if it's a long drawn out process and highly contested and you get legal battles and recourses to the Supreme Court to determine who won, then you could see some volatility prior to year end. And it may not be resolved until mid-December or mid-January.
Yeah, it's going to be a pretty crazy time to see how that all plays out, David. And one of the things to make it a little bit more tangible, and I'd like you to kind of fill any of our new listeners in for this, is your views on how you see the deflations coming after that. So obviously you've said that we're going to see deflation first. So where are we seeing that? And then tell us a little bit about your ideas on hyperstagflation.
Sure. So just to step back, I believe that both are occurring right now. You've got a situation where you got massive unemployment. Some would say it's at the most since the 1930s Depression era, regardless of the headlines. So with all that unemployment, you're not going to see inflation in Gucci belts anytime soon. People are cutting their spending on discretionary items. They're focusing on the things that they need, not what they want. Travel's dropped precipitously. The hotels are in trouble. You got cinemas are closing. You're seeing retail closing left, right, and center. So you got deflation on the discretionary side. And at the same time, in certain areas, you're seeing dramatic inflation on what you would define as necessities. The obvious ones are food. In the meat sector, you're seeing a huge increase in prices recently. You're now seeing it in lumber too. And is wood a necessity? Yeah, well, arguably, if you want to do any renos, if you're building new homes, etc., the housing market's apparently doing well. So I say apparently for a reason that lumber prices have shot up. And why are these shooting higher? Well, gold is another example. Back in March, even though paper prices dropped precipitously, and remember, there's a big difference between paper and physical. But paper prices, silver dropped to $11. But the physical didn't get down there. Premiums exploded. Why? Because you couldn't get a hold of anything physical, even though the market was dropping. And so what is that defined as? A supply shock. There wasn't enough supply of gold and silver to meet demand. So premiums blew out. And the price to buy the actual physical metal shot up relative to the paper price. Well, I say that because that was the first example. Then we got meat. The Chinese owned Smithfield Industries, which is one of the biggest meat processing plants in the US. They shut down 12 of them. What happened to meat prices? They went from languishing around 6-year, 8-year lows to tripling in the space of, 6 weeks, 8 weeks to new record highs because you cut off supply. And this is an economy that's just seen massive spike in unemployment and drop in personal incomes and disposable income. So why did meat prices shoot higher? Because demand is being propped up by stimulus, checks in the mail. And at the same time, you've got less of a product on the shelf. Well, if you've got 10 people going in to buy the same 10 pieces of meat and they find that there's only 5 left, what happens to the price? It doubles. So then you go to lumber, you're seeing the same thing. It's a supply shock. It's not like demand has suddenly spiked through the roof. It's not. Its supply has dried up. That's why prices have gone up. I think it trebled in most places. So could that become more widespread, more pervasive? Absolutely. Supply chains are creaking in various sectors of the economy. And I expect that to continue. And it's funny that when you consider the stagflationary, going to your question of hyperstagflation, the stagflationary 70s, when the Arabs cut off oil to the West, and the economy was in recession, not just in the US, but around the world in the 70s, what happened to the price of oil? It skyrocketed again, a supply shock. Well, people say, demand is non-existent. We're going green around the world and so forth. Oil's never going to shoot higher, blah, blah, blah. Even the Saudis came out today and said, they expect the average price for the next 3 years in oil to be around $50. But what if, confidence is lost in the dollar as it was in the 70s and, the Saudis, Atal, decide to cut off oil yet again, or at least dramatically reduce supply to the West? Well, what do you think is going to happen to oil prices? They're going to shoot higher. I see this as a risk, especially in necessities. Energy is a necessity. That's an obvious one. Food is a necessity. That's another one. Lumber, yeah, maybe, maybe not. You could debate that one. But anything that people need, I expect with all of the stimulus that's coming down the pipe and the potential supply shocks that are going to coincide with that stimulus, especially with an ongoing trade war with China, the risk is that you're going to have not just stagflation, hyperstagflation, meaning the economy is going one way and prices are going the other way. The economy continues to go into recession. on its way to depression. Meanwhile, prices in the necessities which everybody needs is going up dramatically. The Fed has made no secret of their new policy of allowing inflation to run hot. Be careful what you wish for. Say we get 2% and then we get 3%. Inflation is not something that you can just, it's not a light switch. Once the water starts coming out of the hose and you've turned it on, it takes a while to turn it down, or even a better analogy is turning a ship. Once inflation starts to take off, it's very hard to turn the ship back around to go in the other direction. And if we get to 2-3% in inflation, you could see 5%, 8%, 10%. If you look at all the hyperinflations in history, they took place in a matter of months. It didn't take years for this. It happened extremely rapidly. And then you get this talk about the velocity of money and so forth. The velocity of money across the economy is plummeting. But if you get supply shocks at the same time you get checks in the mail and the Fed literally buying everything, stimulus on steroids as I call it, the risk is that you're going to get hyperinflation in necessities, even if the rest of the economy is going down the toilet. And that, in essence, is hyper-stagflation. The economy is going one direction, prices going in the other. It's horrific for savings because the value of your savings in the bank drop precipitously. It's great for some stocks, especially the few that are driving the stock market higher right now. The stocks love inflation, but it's especially good for precious metals and miners, as we saw in the 70s. So that's what I'm anticipating. Are there risks that it doesn't happen? Sure. But you have to go back to whether or not, do you think the economy is doing well right now? Do you have a favorable view of the future with regard to the economy, or do you think it's going to get worse? I am in the latter camp. It's going to get worse before it gets better. At the same time, do you think that stimulus is going to stop and they're going to crash the global economy? Are you going to see a systemic collapse across the board? Or do you think they're going to return not just with similar stimulus that we got in March, or even more than we got in March? I'm leaning towards the latter there too. So massive stimulus, at the same time, there's fewer products on the shelves. What does that do to prices? What does that do to gold and silver? To me, it's not rocket science. And could I be wrong? Yeah, sure it could be. But the odds are in favor of hyper-stagflation, as I call it, going forward. Looking at the data and not the headlines, that seems to be where we're headed.
Excellent, David. One thing that I'd like to get your thoughts on that kind of fits into the supply chain of the side is something that was, more in the headlines, especially the first time we talked, which was the trade war. We've seen it kind of disappear from view. But then this morning I saw an article about the fact that the States now has the largest trade deficit in 14 years. So where does that fit into the picture?
Well, exactly. The policies that have been entered into, the tariff policies and so forth, has simply not worked. I mean, the demand hasn't skyrocketed in the US for foreign imports based on what's happening to the economy overall. And if anything, it's dropped. So how is the trade deficit going up? Well, it's not necessarily that we're importing more. It's just that we're exporting less. And the less demand that we have, or the stagnant demand that we have, you could argue, we're getting more abroad than we are at home. And that's why the deficit is blowing out. Now, I will say this. Trade deficits are a lagging indicator because any movements in the exchange rate and policies takes time to work through the system. So to the extent that the dollar gets weaker over time and the economy gets weaker, you could see that trade deficit reverse. But as things stand, the trade deficit along with the budget deficit is sapping confidence in US policies, I would say, because when you get these twin deficits, that's extremely negative for the dollar, which could be good for the trade deficit going forward, but is certainly not good for foreign interest in buying US treasuries or holding dollars, coupled with the fact that stimulus in the US is probably going to increase, which all plays into the strong gold, strong silver thesis. So I'm less focused on the absolute value of the deficit as opposed to where this trade war could go. China is pushing a policy of more domestic consumption. In other words, less reliance on exports, but even more so, less reliance on exports to the US and more exports to other parts of the world. And they're sourcing more of their imports, which may play into the trade deficit, such as soybeans from Brazil, less of those from the US and more of them from other countries. again, this is due to the conflict between the two on the trade front. China's not going to be dictated to, as I've said, since this started way back in March 2018. They will look for alternative sources rather than be told what to do. And this is one of the consternations for the US. So the risk is, in my opinion, especially from a geopolitical perspective, because there's a lot of saber rattling between the two, especially with regard to Taiwan lately, that the trade war could get worse before it gets better. And let me ask you this. If this crisis is global, which it is, and China has its problems at home and the US has its here, who do you think China is going to focus on in the future in terms of making sure people are fed, making sure that they've got enough supply for their own market? The Chinese, they're going to look after themselves. So the risk is that you see more supply shocks in terms of either higher tariffs in the US on Chinese imports, or the Chinese simply cutting us off, because we still rely on them for a lot of our imports. So that's what I mean by the supply shocks is a key theme that you need to focus on, because we've already seen it in gold, meat, now lumber, and it could become pervasive in the near future, especially in necessities. At the same time, you've got stimulus. And things like the trade war, that just adds to the problem, making it a much more serious issue going forward. So when I look at all the risks, I try to find counterpoints to that argument that we get hyper-stagflation. The odds clearly favor the latter. The alternative, just going back to my original thesis, the alternative for the Fed not printing new stimulus, the Congress and US Treasury not agreeing on more checks to the Americans, not dropping money from bombers, is systemic collapse. If that's what they want, all they have to do is pull the plug on everything. And that's what will happen. Markets will crash in tandem with the economy. It'll all come tumbling down. On the other hand, people might say, well, Dave, you talk about this hyper-stagflation. If we get inflation, due to the stimulus and the supply shocks you mentioned, sure, can't the central banks just raise interest rates? They have that, they're at zero. They can raise them 1%, 2%, 3% just to get inflation back in line. No, they cannot, because there's this thing called debt, and it's at record levels in absolute terms and in debt to GDP. And the total debt to GDP in the US, if you take into account corporate debt and household debt, is north of 1,000%. Unfunded liabilities. It's north of 1,000% of GDP. So no, the Fed cannot allow interest rates to rise. Even Volcker confirmed this recently, that they don't have the tools now that they had in the 70s. They didn't have the debt that they have today in the 70s. So they had the opportunity to raise rates, which Volcker did, and then some, to curtail inflation. They don't have that tool this time around. So there's nothing to stop. Once inflation takes off, it's gone. That's why I think the end game for all of this is the Fed, QE, MMT, whatever you want to call it, the stimulus. Once we reach a point where all that does is create higher and higher prices for necessities, everything, they're forced to pull the plug. And when that happens, game over. There's your depression. And I don't believe that that's too far away. But in the meantime, your safe harbor under such circumstances is to own at least a little gold and silver as insurance for what's coming, in my opinion. Because if that plays out, gold and silver and the miners are the assets that are going to outperform anything and everything else, especially if the dollar collapses at the same time.
So, David, as you're talking about the fact that they cannot raise interest rates, something we spoke about last time was that they want to cap bond yields, which will also mean that they'll cap real yields. Is the consequence of that the same, like basically creating that depression?
The capping real yields and capping nominal bond yields and real yields, the purpose of that is it's the same discussion said a different way as capping interest rates. The government cannot withstand the loss of confidence that dramatically higher interest costs on the debt. Let's say they reach a situation where the interest costs on the debt is greater than the amount of tax they take in revenue. What that means is not only can you not pay your debt, you can't even pay the interest on the debt. So break that down to an individual level. Somebody buys a car and they finance it and they get a loan to buy the car and there's an interest rate of 5% on the car. What do you think the loan provider is going to think? If not only can they not provide the payments of principal, they can't even pay the interest on it. And the guy wants to go buy another car and he wants to take out a loan with the same loan provider. the loan provider is going to tell them to pound sand. So when the US reaches that point where the tax revenue they're taking in is less than the interest costs they're paying on the debt, which is massive. We're in the 20s of trillions right now. That's just the public debt. That's just the government debt. There's a whole pyramid of debt on top of that. That when they can't even pay the interest on that debt out of the tax revenues, who's going to buy their debt abroad? The Fed will buy it every day and twice on Sunday, but then what happens to the dollar? All confidence is lost in it. I mean, we're in Weimar territory at that point. And that's why they cannot allow interest rates to go up, is because the interest on the debt would basically signal the impending insolvency. One could argue the US is already insolvent, but it would become obvious to the rest of the world if the interest cost on their debt becomes clearly unpayable from a US perspective. If that were to happen, then it's game over. So they have to keep interest rates down. Even Volcker confirmed it. They don't have the luxury to raise interest rates for that very reason. The debt is so high that the cost of paying a higher interest rate on that would be greater than all of the revenue that the US takes in. And if you can't even pay the interest on your debt, who's going to buy your debt? Who's going to provide you with a loan? No one. Maybe the IMF will throw you a few pennies, but, it's game over at that point. So that's why they have to keep real rates, nominal rates low and continue to do so and even go negative. I mean, look at Japan. Japan has a massive debt to GDP. If their interest rate goes to 2%, they become insolvent. Their interest is greater than their tax revenue. 2%. I think it's actually even less than that now. But if you do the math, 2% on their massive debt load is more than the tax revenue they take in every year. They are insolvent. So that's why they can't hike rates in the event of inflation. So you've got an asymmetric risk to the downside in real rates. And what's that do for gold and silver? Go back and look at history. That just means they're going to go a lot higher.
Nearly perfectly inversely correlated, right?
Exactly.
So, David, as we're talking about and really trying to get some perspective for where we are in this cycle and what we could see, within the next 3 to 6 months, one of the things that you like to bring up is bank positioning. So can you tell us a little bit about how the banks are positioned right now, let's just say in gold and silver?
Well, they were short and they're, trying to get out of those shorts. Now, when we're looking at bank positioning, we're only looking at their futures positions. They could have other derivative positions, options and so forth out there that are covering those positions. But based on what we see on the futures exchange, they were significantly still short gold. They're trying to reduce those positions. And in the process of squeezing out all the weak longs with this move down, they're achieving that to some extent. And, this is less so for JP Morgan. It's for the rest of the banks. JP Morgan is in the enviable position of having one of the biggest, if not the biggest, pile of physical silver in the world. So they're insulated. When they short the silver market, they've covered that with, their long physical holdings to the left. And so it's the rest of the banks. They're trying to pair those positions ahead of what they know is coming, in my opinion. And in the short term, you're seeing that they're long the dollar. So when you couple those things, they're short gold and silver and they're still short, but they're trying to get that short position down, but they're massively long the dollar. Well, that tells you that they're getting ready for a pop in the dollar and further downside in the metals. Now, is that a given? No, but it's just one data point that tells you that there is a risk that we still see some further downside in the metals before this next ratchet higher, and you see upside in the dollar. Now, could they go up together? Yes, they could. The negative correlation could break down, but we just have to go on the facts as they are and what has transpired to this point. And to this point, they are inversely correlated. Could that change? Yes. But to the extent that it continues, if the dollar continues higher in the short term, as some of these longs are worked off and they make their profits on the dollar going up, that's the commercial banks, gold and silver and the miners could see some further downside. And then once this stimulus kicks in, game over. But you got to think about this, that the banks may be prepared for, it all connects. See, that's why it's good to have a big picture view of things. If the banks are anticipating a contested election in November and greater risk off, which is typically beneficial for the dollar, that's why they're so long. They're anticipating that there's going to be trouble on the political front. It could take a while to be resolved, and therefore the dollar goes higher. Well, what happens to everything else if that happens? stocks typically go lower, and so does gold and silver. And given that that's typically what happens, that's where, the odds favor that is what's going to transpire.
Excellent, David. I think that puts a tidy bow on a lot of your thoughts here and everything that we need to tie up. Why don't you tell us a little bit about something you and I were talking about before the call about logic, data, and common sense?
What are those? I've forgotten. They don't exist anymore. No, it's just that it seems, today all that matters is who's holding the microphone, because if you, instead of listening to what you're hearing on the TV, you go and read what's actually happening out there from a financial perspective and a broader perspective, the data, tends to conflict with the prevailing narrative, and common sense tends to differ from what the prevailing narrative is. And unfortunately, what we've seen is the loss of diplomatic discourse, I'll put it as, honest debate. Somebody saying black and the other person saying white. And those two people being able to have a conversation with each other over, why they think A and why you think B. And I've found that to be extremely beneficial in all my views, despite what many people think, that I do welcome alternative discourse, but that's something that's based on, research and has a rational basis for their view. So, for example, a few months back, Luke Roman and Brent Santiago had a difference on the prospects for the dollar. And it got heated at some time, but they had a very healthy debate on both of their views on the prospects of where the dollar was headed. And they disagreed, and ultimately they agreed to disagree. But people got to hear both sides of the argument and make up their own minds. Nowadays, we've got censorship, we've got people shouting down one another, we got cancel culture, and that's a sad development because, there are some things that I see out there that it's obvious they're wrong. Common sense would dictate that it's wrong. But, if you say boo, you're shouted down. I welcome any alternative arguments to what I'm saying. And I don't mean I say it's going up and then I give a detailed argument and then you respond, well, I think it's going down to 800. That means nothing to me. Give me a reason for why and detail, not just a chart. Give me a rational argument for why you believe that. And I'm open to it. I'm all ears because I'd rather know that I'm wrong before I'm proven wrong, because then I can do something about it. But unfortunately these days, Tom, it's becoming even rarer commodity than gold and silver, because you look at the likes of Twitter and YouTube and so forth, and unfortunately you're seeing less and less honest opinions. Actually, the most honest opinion you get these days is a conversation with your neighbor. But with the COVID-19 restrictions, you can't even do that now because of the social distancing requirements. So it's a shame. But, these pendulums tend to swing from one extreme to another. And that's what I see happening right now. The question is, will that pendulum swing back? And I think we're going to find that out in the next 2-3 years. It's going to be pivotal for the next 20, in my opinion, or maybe longer.
Couldn't agree more, David. It's always valuable to be able to rationally discuss things like this. As always, we can find you at Global Pro Trader on Twitter and your articles on Sprott Money. David, thanks very much for your time and opinion today.
Oh, can I just finish one thing I wanted to say to you, which was probably obvious from my comments, Tom, but I do like to finish on this point so that everybody's crystal clear. As you know, I like to say this. I've said it before in your calls. I'm mega bullish gold and silver, and from a trade perspective, the miners long term. Mega bullish. I believe gold's going a lot higher for all the reasons that I mentioned. Silver's going to go even higher than gold. Miners will outperform silver to a greater extent, and junior miners will outperform senior miners. That is all my humble opinion. And could I be wrong? Yes. But if we get stimulus on steroids in the next 3 months and 6 months, whenever it comes, if we get it, and I believe we will, it's only a question of timing, do you really care when it happens if you know it's going to happen? I don't know what's going to happen, but I believe it's a high probability for all the reasons I've already mentioned. If that happens, just look at the charts for gold, silver, and miners post the March to lows and get your ruler out and make a longer line to the upside. That's what I see coming. Just so people are clear, I think somebody who's a mega bull in gold and silver since 2015, or if you talk to my parents since 2008, but certainly since 2015, that when they say there's a pullback coming, it has a greater degree of credence or credibility than someone who's a perennial bull. I mean, I believe that's stating the obvious, but the fact that I have to say that speaks volumes. When I talk about downside, it's only with respect to short-term reversals, pullbacks, opportunities to buy the dip, because I am a long-term mega bull, given the prospects for the dollar and all fiat currencies going forward, in my opinion. And I believe gold and silver are the new TINA assets for everyone going forward. TINA, there is no alternative other than gold and silver, physical, in my opinion. Just wanted to finish on that note, Tom.
Not a problem, David. As we say, higher lows define a trend, right?
Exactly. Yeah, you can't have an uptrend without higher lows. You can't. It doesn't exist. Trends are defined as higher highs and higher lows. So you keep going higher and higher.
I thought everything just went up in a straight line, though.
Oh, yeah. Sorry. You're right. That's right. When you throw a spear up in the air, it doesn't come down.
Perfect. Well, not with enough stimulus, right?
Exactly. And if you get an inflatable balloon underneath, it'll still spike it. But anyway, yeah, no, nothing goes up in a straight line forever. Nothing goes down in a straight line forever. We get waves, and you will get opportunities to buy. But this one is a fantastic opportunity. Think of where we came from. I mean, silver was about to cross 30 recently. It's been as low as I think it's at at least a 22 handle. If you see 21.20 in 2 to 3 years, if we're at, I'll be conservative, 100, will you give a hoot whether you bought it at 19 or 23 or 27? Really? I mean, yeah, your percentage gain will be higher, but will you really care? What if it's at 500, 1,000, 2,000? Sound like ridiculous numbers. Not if gold goes to 5,000, 10,000, 25,000, 50,000. Who knows? But now is a fantastic time to buy. You will get pullbacks on the way up here. You'll get reversals to wash out the week longs. Don't buy the negative sentiment. Go against it. When everybody's throwing in the towel, buy, in my opinion. It's worked for me so far, and it'll work for you. It's knowing when that sentiment has been fully thrown in, when that market has capitulated. But, it's always be careful following the herd, especially at peaks.
Sound advice there, David. Thank you so much for your time today, and we always appreciate your viewpoint.
Thanks again, Tom. Really enjoyed it. Look forward to our next one.
Absolutely. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?